3M reported earnings this morning, and frankly, there wasn't a lot to like. Shares are down about 12% as I'm recording, and this quarter really continues this long-term decline of the company. 3M has been focused on efficiency and optimizing profits for 20 years now. But the problem is when you optimize for short-term profits, you give up long-term opportunities. You're not investing in capital expenditures, in research and development, in developing those new and innovative products that have driven 3M for over a century. Now, as much as management used the word innovation on the conference call, and they did over and over again, ask yourself, what is the last innovative product that you can remember 3M developing? I have to go back over 20 years to products that you probably don't even realize 3M makes, like brightness enhancing film and privacy films. These are products that drove the company's revenue growth for a lot of years, but now we're seeing that a lack of investment in the business is really hurting organic growth and long-term profitability. So that's what I'm going to dig into today, is exactly what the trends are long-term from the business, because really the numbers tell the story. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they're going to give you their top 10 stocks to buy right now. So let's go right to the report and the earnings presentation. This was the first page of the presentation that I really started to see exactly what management was going to say. And this is really the second page with content on it. So original guidance from January 2023 was that 3M was going to report adjusted earnings per share of $8.50 to $9 per share. What they actually reported is $9.24 per share. So you say, wow, that's great. It's exactly what you want to do. Under promise, over deliver. But then you look at a number like this, adjusted free cash flow conversion. This is, what does your free cash flow look like compared to net income? And a lot of times companies will report higher net income than they have free cash flow because they're doing things like spending money on capital expenditures or investing in the business in general. 3M says that they're going to have free cash flow conversion of 123% for 2023. This means that their cash flow is higher than net income. What does that tell you on the surface? It tells you that they're probably not investing in things like capital expenditures that are going to grow the business long term. That was where my head went to first. I'll show where the numbers behind that in just a second. The final thing, adjusted organic sales growth. So management said a year ago that in 2023 they expected organic growth to be flat to -3%. So on the upside, you say maybe revenue is going to be flat on an organic basis. Where does it actually come in? -3%. So that means the business itself is shrinking. It is getting smaller and weaker. And the reason that this is a 3M problem and not just an individual markets problem is that this is something that has happened across the board, across the company's divisions. This is the business group performance slide, and I'm going to just go through each of these just a little bit. The left side of this column is fiscal year 2023, organic growth, and then operating margin, then the same metrics, but just for Q4 is on the right. So safety and industrial, this is going to be all kinds of industrial products that you probably don't know that 3M makes, but that they've been making for a very long time. It includes respirators. That was one of the big businesses during the pandemic. But organic growth, -5.1% for the full year. For the fourth quarter, -3.9%. So just a terrible trend from a revenue perspective. You also see that margins are going down, 22% for the full year, 19.7% for the fourth quarter. Transportation and electronics. Remember some of those products that I talked about earlier, brightness enhancing films. There's all kinds of films in things like smartphones that 3M makes and has always made. So a lot of value from those products goes to 3M. But now that we're starting to see some sales slow in a lot of these electronics products, you're starting to see weakness at 3M. -3.5% organic growth for the full year, up a little bit for the fourth quarter. So a little bit of a positive trend, and margins were flat. This is something that you're going to see consistently with 3M. Benefits from restructuring, pricing, and strong spending discipline. So talking about increasing prices and reducing spending. That is not how you grow a business like 3M long term. You don't say, hey, we cut our way to growth at 3M. Healthcare, another strength for a long time, now is starting to be a point of weakness. 0.7% growth for the full year on an organic basis and -1% for the fourth quarter. These margins are really bad When you look historically at healthcare, down to 18.3% in the most recent quarter. And consumer, this is really what 3M is known for. Post-it notes, all of those consumer products that you can get at big box retailers, negative 4.7% for the full year and negative 2.2% for the quarter, and operating margin just 18%. So the trends are weaker revenue, not keeping up with inflation, volume is not strong, and then pricing is getting worse as well. What do they expect for 2024? Well, again, you're looking at organic sales growth of flat to plus 2%. Adjusted earnings per share, remember they were expected to be relatively flat, $9.35 to $9.75. And adjusted free cash flow conversion, again, expected to be right around 100%. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now, I talked about how this problem has been 20 years in the making at 3M. And I think this chart really shows exactly what I'm talking about. You can see that going back to 2004, 2005, gross margins at 3M were over 50%. They had a lot of pricing power. They were continuing to at least steadily grow the business. Operating margins were also extremely high. But you see over the last 5 years, margins have started to deteriorate. Gross margins now down to the low 40% range, and operating margins are dipping as well. You add in the fact that 3M is now not growing as a company. It's not increasing volume. It's getting a lot of its organic growth just by increasing prices. And now you start to be in a downward spiral. And I think that's really what we're seeing from 3M. They're not investing in the future by investing in R&D and new capital equipment. That always used to be their differentiator, was those two things. They're losing a lot of their supply power because now you don't have control of supply in the market by selling through mostly big box retailers and into channels where you really control where a lot of those products are going. Now there's more demand power. If you buy something on Amazon, you can buy any Post-it note, any brand. You don't need to buy 3M because that's all they have sitting at a Target or a Walmart store. So the dynamics in the industry have changed, and we're seeing that 3M is really struggling as a result. It's not coming out with innovative new products. It doesn't reach customers directly through any major channels, and slowly the business deteriorates over time. So your only reaction if you're management and you need to pay this dividend, you need to return money to shareholders, is to cut more, to cut operating expenses, to cut R&D, to sell businesses that you don't think are part of the core anymore. They continue to do all of these things, but all of these things accelerate your downfall as a company. And that's fundamentally, I think, what we're seeing at 3M. This has been a long time coming, but we're now seeing exactly what happens when your growth was driven by innovation and your focus now has been on efficiency and squeezing as much as you can out of the business. You lose that innovation. You lose what drove you to become what you are as a company. And investors are paying the price now. The stock really hasn't gone much of anywhere over the last 20 years, has not kept up with the market in any way, and I don't think it will in the future as well. So what do you think about 3M's results? Leave your comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.